The JP Morgan Nasdaq Equity Premium Income ETF, known as JEPQ, is finally seeing some red after having an impressive start to the year, up around 14% year to date. And keep in mind that's not even including dividends. Now in this video, we're going to dig deep into the covered call ETF JEPQ, which, side note, I happen to consider one of my absolute favorite covered call ETFs across the entire market for a plethora of reasons. Then I'm going to share with you why I think this ETF could be offering massive growth and huge income potential from here, also for a variety of reasons. Now, if you like dividends, consistent income, and growth, make sure to drop a like down below and stick around because you are not going to want to miss a thing. So first things first, heading over to the JP Morgan website, it says right here, JP Morgan Nasdaq Equity Premium Income ETF, or JEPQ. Now the overview of this ETF is simple and to the point. It says designed to provide current income while maintaining prospects for capital appreciation. It generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and, of course, stock dividends. It then says seeks to deliver a significant portion of the returns associated with the Nasdaq 100 index with less volatility because of that option overlay. It then says constructs a long equity portfolio through proprietary data science-driven investment approach designed to drive portfolio allocations while maximizing risk-adjusted expected returns. Now, the investment process says applied data science process utilizing 40 plus years of JP Morgan proprietary data to create a fundamental framework for security selection and portfolio construction. Then with that, it says option overlay. 1 month out of the money call options designed to generate income and give investors a portion of the upside with reduced volatility. So the covered call strategy and using options is something that I'm definitely a huge fan of. I use it across my portfolio throughout my positions actually. And just a side note, one thing to keep in mind is the fact that this ETF uses 1 month out of the money call options when so many of the newer ETFs like TSLY or even JEPY are now using expiration dates, sometimes 1, 2, 3, 4 days till expiration. The entire game is just getting crazier and crazier. But then with that, it says JEPQ, a well-represented, fundamentally driven Nasdaq 100 strategy that seeks to provide clients with monthly distributable income via option premium and dividends. Now, I think it's also important to note that the expense ratio for JEPQ is 0.35%, which honestly seems kind of low considering a lot of the newer covered call or option ETFs out there, like TSLY, like the new Defiance ETFs. A lot of these new ETFs out there have like a 1% expense ratio. So it's kind of crazy that just because as time goes on, things change so much. And now the fact that 0.35% seems like a fair expense ratio, it's honestly sort of mind-blowing. But the fact that this ETF is, of course, actively managed and the strategy around the options, it sort of makes sense. You're going to pay a little bit more than more of a passively managed fund. Now, JEPQ, as of right now, it says there's 87 different holdings right now. But the top 10 holdings are things like Apple stock, which of course we all love, Microsoft, Google, Amazon. Then we have things like Nvidia and Meta with lots of option overlays in there. Now, at the top of the video, we talked about the fact that JEPQ was not only up around 14% year to date, but as of just recently, the last 5 days or so, JEPQ is finally in the red. And actually this ETF is in the range where I've actually been buying a few more shares here and there finally, because I've been holding off until JEPQ got a little bit closer to the mid 40 range. Now, looking at the max time frame, JEPQ still is in the red, 3.87%, but of course the massive dividends have made up for it. This ETF is well into the green since the ETF's inception. Now, some of my thoughts just as of recently when it comes to JEPQ and how it's been trading, I do think that JEPQ in the lower 40s, closer to the low end of the 52-week range, 39.61, is going to be when I start buying quite a few more shares. And this is based on the portfolio breakdown, which is mostly made up of technology stocks, hence the Apple, Microsoft, Amazon, Alphabet, etc. But that being said, when the market does go red, JEPQ is going to go red with it for the most part. And of course, because of the option overlay, when the market does turn red, at least if it's just a little bit red, it should sort of protect the ETF for the most part. But that being said, when some of these names in technology do turn around and turn green, which I think they should within the next few months, hopefully, this ETF, in my opinion, could easily be trading somewhere near $50 per share again. So you might be asking yourself, well, what's so special about technology and why does JEPQ have so much of its overall holdings based in it? Well, the great thing about tech stocks in general is that they're known to potentially deliver significant growth. With technology advancements and innovations that are continuously going on, there is crazy opportunity in the market to make a lot of money and some major moves in the technology sector. Now, with the JEPQ ETF being so heavily invested in technology, it is definitely going to have a much higher beta. Now, market beta, also known as systemic risk or equity beta, is a measure of a stock or portfolio's sensitivity to the overall market movements. So beta is a commonly used term as far as risk indicator. A beta of 1 indicates that the asset or portfolio tends to move in line with the overall market. If the market increases by 1%, the asset or portfolio is expected to also increase around 1%. Now, with JEPQ's holdings being majority technology, that means that this ETF is going to have a much higher beta, again, compared to something like JEPI. But let's be honest here, I'm not only buying into JEPQ to make money off the actual share price. I'm buying into JEPQ to get a nice juicy distribution on a monthly basis to then use the money as of right now, for me personally, to reinvest into other dividend paying stocks or ETFs, but in the future to use these dividends for maybe things like bills, living expenses, vacations, whatever it might be. Now, looking at JEPQ's most recent monthly payouts, there was a short span there where JEPQ and JEPI were paying like well below 40 cents per share per month, but just as of recently, they both bumped up a little bit. Due to there finally being some volatility back in the market, you can see on the 1 day, the VIX is up 11.07% as of right now. And over the last month, the VIX is up 24.47%, which is much more than we've seen here in a while. Now, of course, when it comes to options and covered call ETFs and things of those sorts, a lot of the premiums are going to be much bigger, and a lot of the income is going to be much juicier when the volatility index does spike up, which is why if you look at times like back in 2020, JEPQ is paying like 68 cents or even 55 cents per share per month, which makes the most recent dividends that's been paying for the last few months seem absolutely tiny. So in my opinion, I think that in the more short term, we're going to see some more volatility, but then from there, I think things are going to calm down, which means that as of right now, JEPQ could be a good buying opportunity. But in the meantime, those monthly dividends could be getting bigger and bigger with more volatility being introduced into the market. Now, lastly, I want to talk about JEPQ's year-to-date performance if you look at dividends and price return included. So looking at JEPQ's total return year-to-date, we're at almost 24% return. And this is even with JEPQ being down a few dollars per share. Now, a lot of the other covered call ETFs sometimes get a bad name, things like QYLD, which is down 34.6%. Of course, not dividends included, but either way, there has definitely been ETF price decay, or whatever you want to call it, since this ETF's inception. Now, this is of course because mechanically speaking, covered call ETFs sort of naturally just do decay over time because of the covered call, sort of limiting the upside potential, but not necessarily protecting the ETF completely during the downside. So what comes from that naturally is an ETF that loses overall price. But in doing so, investors are hoping that at least the dividends on a monthly basis, or whatever it might be, can make up for it. Now, that being said, I've been very impressed with JEPQ's overall performance since the ETF's inception. And although JEPQ is a little bit red since inception, I think this ETF has performed and held up really well compared to many of its peers. But when it comes to covered call ETFs, especially JEPQ included, is this something that you currently have in your portfolio? Let us know down below why or why not. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.